Despite all these fears about the growth outlook, though, I mean, you seem to like one of the arguably riskier areas of the market in terms of your fixed income portfolio, still with a preference to emerging markets, high yield. Walk us through the case there.
Nancy, I think the logic there is we all know this is going to be a tough period. I mean, our base case for economic growth is zero globally, so that's down both developed markets and emerging markets. Developed markets likely to be negative, and emerging markets probably 1 to 2%. But within the space, and with all the support given from the government, quality companies are now getting the extra fundamental support they need. If they've gone into this with not too much baggage and they're likely to be able to see through to the other side because of the support, then there's some very attractive valuation, particularly in spaces like emerging market high yield, where the reward to risk, so that would be the spread to turn of leverage, is 2.5 to 3 times that you see in the US. So you're getting paid to take risk, but we've just got to make sure we choose the quality. We've got to do our credit work and make sure you miss the default. Because there is definitely going to be an increase in defaults from here. So we've got to be extra careful on selection, and quality is number one, but there is definitely valuation and opportunities building.
But Gareth, even if you're selecting quality, do you worry about a ripple effect on certain names, let's say, given what's going just in the oil space at the moment and what that could do for some high yield areas? Because it doesn't seem as though we're out of the woods quite yet in terms of the volatility with oil prices.
I mean, oil is a sector that we're staying away from for numerous reasons. I mean, in emerging markets, we don't have the same sort of smaller oil companies that US high yield, for instance, has, where they're very concentrated on energy shale, which is sensitive to a $50 per barrel oil price. In emerging markets, oil tends to be more government related. Asia, for instance, is a large part of EM high yield, and that is an oil importer, so it's constructive oil. So we do need to be selective of which companies to buy, and oil is a sector which is struggling a lot. We need to ensure that the oil in emerging markets is also backed by a strong sovereign. And there are some sovereigns that are struggling where oil is their main component. So oil is probably not going to be our largest bet within EMI yield, but it is something to consider, particularly if it's more refinery and more focused towards an economy which is an oil importer in general.